Hello, I'm Eric Fernwood. Welcome to another Las Vegas real estate video. In this video, I'm going to cover a 1031 exchange. How would you like the ability to sell one investment and then buy other investments with the proceeds with no tax consequences? With real estate, you can. This is another unique advantage. Let's go walk through how this actually works. These are representing little deeds of trust or something. Suppose you bought a property here and then 1, 2, 3, 4, 5 years later, you've had good appreciation, but you think you can do better. With a 1031 exchange, you can sell this single property and buy one or more what are called similar types of properties. And the definition of similar is very broad. For example, this could have been land and you could have bought single-family residential rental housing, or it could be water rights. There's a wide range of things you can do, but the concept is you can sell an item and purchase others that are, quote, similar, according to the IRS, with no tax consequences. In this slide, I'm going to be a little bit more specific. Section 1030 of the U.S. Internal Revenue Code allows investors to defer capital gains taxes on the exchanges of like-kind properties. Section 1031 specifies that if an asset is sold and the proceeds of the sale are then reinvested in a like-kind asset, then no gain or loss is recognized. This allows the deferment of capital gains that would otherwise have been due on the sale. Note that the conditions and restrictions apply. You need to seek professional advice, and I'll talk a little bit about that later. And there are definite time frames and forms that must be met. Before I talk further about 1031, let me answer the most frequent question I get from my clients. No, you do not have to be a U.S. resident or citizen to take advantage of 1031 exchanges. Now, I'm not a tax advisor, but I've asked this of several people who are, and I've looked at the IRS code, and there is no mention of residency or anything else. So how is 1031 actually used? Well, for example, suppose you purchase one rental property. You've held it a few years. You now have a lot of equity in the property because its value's gone up and so forth. Well, remember, the return on equity is always zero. Equity is security, but no one is writing you a check. You don't make money off of equity. What you could literally do is sell this single residential property and buy two condos. You could do the same thing and move into commercial. You could buy some office condos. You could do a bunch of things like this. And you would be able to move your property both in terms of splitting it and in terms of types. Now, one of the most common uses of 1031 as an exit strategy is to sell this group or some subset of properties and purchase a triple net lease. The triple net lease is kind of a wonderful vehicle because the tenant pays all real estate taxes, building insurance, maintenance. They manage the building. They do everything. And the only thing you do is get a monthly check from them. So suppose you no longer wanted to be in real estate. Well, bundle it together, sell it as a package, and move it to a triple net lease. Now, who does triple net leases? The U.S. Post Office is a good example. Most of the drugstore chains, McDonald's, Starbucks, Burger King, Wendy's, all these people do not want to have a tremendous amount of money tied up in the land because there is no return on equity. What they want is to be able to have the minimum amount of money going into these physical facilities and the maximum going to money-making things like more inventory. Now, a lot of these triple net leases, I'm not an expert in this one, but the ones I've seen are like 25, 30 years in length with escalators built in there for inflation. There are some renewal clauses. They're quite wonderful in terms of being able to take a lot of real estate and move it into a no-headache situation. Okay, well, 1031 is the vehicle to wealth. Since you can expand your holdings over time without tax consequences, you need to be very careful and you need to work with an intermediary. Every time I've done a 1031 exchange with a client, we've used an intermediary, and the intermediary is the one who basically holds the funds between the time the original properties are sold, the next property is purchased. They also make sure that you comply with the 45-day tasks, the 180-day tasks. There's a number of things involved. You have to use an intermediary. It's just too risky to do it any other way. If you'd like the name of the intermediary that I've been primarily working with, contact me. I'll be happy to give you that. That brings us to the end of this video on 1031 exchanges. For more information on real estate investing, check out my website, www.ericfernwood.com/invest. Thanks again. Hope to hear from you soon. Bye-bye.